Canadian with a $400,000 mortgage who signs the bank's first renewal offer at 5.7%, instead of negotiating to a competitive 4.74%, overpays roughly $24,600 in extra interest over a single 5-year term, according to Neobank's renewal modeling. That letter feels like a formality, but it is quietly the most expensive piece of mail you get all year. Stick with me because there is a simple script that closes most of that gap. I read the fine print so you don't have to. That gap between the bank's convenient renewal rate and what you could actually get is around 1 full percentage point. And on a $500,000 mortgage, that difference costs about $3,800 in extra interest over 5 years, according to Neobank. Today, I am handing you the exact 3-step playbook and the word-for-word script to claw that back. Here is the stakes part. Federally regulated banks only have to send you a renewal statement at least 21 days before your term ends, according to the Financial Consumer Agency of Canada, and there is no rule saying that offer has to be their lowest rate. That short window is the trap. Lenders bank on sticky customers signing fast, because switching feels hard, so the letter is priced with a loyalty premium baked in. Get this wrong on a $400,000 balance and you are looking at that $24,600 gap over just one term. Move 1 is to audit your timeline before the letter ever arrives. Log into your bank's online portal, open your mortgage account, and write down your maturity date, current interest rate, payment, and remaining amortization. Then count back 120 to 150 days from maturity and set a calendar reminder, because industry guidance from Neobank and Mortgage Renewal Hub says starting 4 to 5 months early is when lenders can actually hold a rate for you. Good looks like serious shopping months ahead, not a panicked signature 3 weeks before. Layer a second reminder in for 21 to 30 days before maturity as your backstop. This is the point where the FCAC mandated renewal statement is guaranteed to have arrived, so you can line the bank's number up against everything else you have gathered. The goal is to never be caught choosing under pressure. By this date, you should already have a final written offer ready to accept or walk away from. That single habit is what turns a 21-day rule from a trap into your deadline, not theirs. Move 2 is where you build real leverage. Check the posted and special offer rates from at least 2 other big banks or credit unions and save screenshots. Then contact a licensed mortgage broker and ask for a written, rate-held quote. Something like a 4.79% 5-year fixed with a 120-day hold and legal fees covered on a switch. Industry guidance from Mortgage Renewal Hub shows written competing offers are often half a point to a full point lower than a bank's first renewal number. Good looks like 3 or more documented offers in a folder before you ever pick up the phone. Take a real example. On a $480,000 balance with 23 years of amortization left, accepting a bank's 5.79% loyalty rate instead of matching a 4.79% broker quote costs roughly $29,000 in extra interest over just that next 5-year term, according to Neobank's modeling. That is 1 point of rate on 1 signature, and it is exactly why those 3 written quotes matter. Without them, you are negotiating with nothing but hope. Move 3 is the part your bank hopes you skip. Branch staff can only trim a little, but retention desks have the authority to match or beat broker quotes, according to Mortgage Renewal Hub. Call the mortgage renewal or retention line listed on your statement and say, "My mortgage is up for renewal on this date. I've been quoted a specific rate on a specific term by another lender with legal fees covered, and before I commit, I want to give you a chance to beat or match it." This is general information, not personal advice, so always check the terms and your own circumstances before switching. If the first rep can't match your quote, say, "Can you transfer me to your retention or customer loyalty team? I'm comparing options but would prefer to stay if the terms are competitive." When an acceptable number comes back, say, "Please email me the full details in writing so I can review before I decide, and do not commit until the written offer matches what was promised." Getting it in writing prevents backtracking and lets you take that quote to another lender to be beaten. If this is useful, subscribe. The next breakdown is already coming. Before I get to the last part, which is the most counterintuitive piece of this, here is what escalation actually buys you. When one borrower called his branch without naming a competitor, the advisor trimmed his rate from 5.79% to 5.39%, a token cut. But after he emailed a screenshot of his 4.79% broker quote and reached the retention desk, the bank came back at 4.84%, and that move from 5.39% to 4.84% saved about $1,500 in interest over the term, according to Neobank. Same customer, same day, the only difference was the script. Here's the most counterintuitive piece: the rate is not the only thing on the table. Competing lenders often cover standard legal or switch fees, typically $800 to $100 on a switch, as part of their promotion, according to Neobank. You can also push to move from a 10% annual prepayment allowance up to 15 or 20%, and an extra $200 a month toward principal on a 23-year mortgage can shave years off the term and save tens of thousands in interest under standard amortization models. Most people fixate on rate and leave this money completely untouched. Now stack it across your whole mortgage life. Over 4 to 5 renewal cycles, a household that consistently signs high letters or accepts weak branch offers gives up roughly $45,000 to $65,000 in extra interest compared to a disciplined negotiation strategy, according to Neobank. Add recurring fee differences and weaker prepayment terms, and the lifetime hit easily reaches $50,000 to $70,000 for a single family. That is the true price of treating renewal as a formality instead of a negotiation. The number one mistake is negotiating empty-handed. Most borrowers call the branch, mention they heard rates are lower, but never cite a specific written offer, so they only get a token reduction, according to Mortgage Renewal Hub. The second mistake is believing the renewal letter is the bank's best rate. It is not, and there is no rule requiring it to be, per the FCAC. Naming a specific competitor rate, pausing, and asking for retention is what actually unlocks the internal pricing grids. Let's run it back fast. Audit your timeline and set a reminder 120 to 150 days before maturity. Then gather 3 written rate-held quotes, including one from a broker. Call the retention desk, not the branch. Name a specific competitor rate, escalate if the first rep can't match, and get the final offer emailed before you commit. Finally, negotiate covered legal fees and better prepayment privileges on top of the rate. That is the full playbook that closes a $50,000 gap. Your renewal letter is a first offer, not a final one, and now you have the script to treat it that way. Next, I'm covering how mortgage prepayment penalties are actually calculated, the hidden formula that can cost thousands if you break your term early. So if you want to catch that, subscribe so you don't miss it. Remember, this is general information only and not financial advice, so always confirm current rates and terms for your own situation.